30%, in hours, not over a quarter, not during a recession, not after a war declaration, hours. That kind of move is not normal. It is not healthy. It is not just volatility. It is a stress fracture inside the system revealing itself all at once. Because when an asset like silver collapses that fast, you are not watching price discovery, you are watching liquidation. And liquidation does not care about value, it cares about survival. If you were holding leveraged exposure, you didn't have time to think. If you were watching from the sidelines, you probably assumed something catastrophic had happened. But here's the uncomfortable truth. Nothing fundamentally changed in the industrial demand for silver in those hours. Mines didn't shut down, solar panel orders didn't vanish, the global economy didn't freeze. What changed was positioning, and when positioning breaks, price follows. To understand why this sell-off was so violent, you have to understand how modern silver trading actually works. Silver today is not just a metal, it is a layered financial instrument. At the base, there is physical metal, bars, coins, vaulted bullion. Above that sits futures contracts, leveraged agreements to buy or sell at a future date. Above that sit options on futures. Above that sit ETFs representing pooled exposure. Above that sit structured products and derivatives used by institutions. Each layer increases liquidity, each layer increases leverage, and leverage is beautiful in calm markets. It allows traders to control large positions with limited capital, it tightens spreads, it enhances participation. But leverage has a dark side. When volatility rises, leverage turns from an amplifier of gains into an amplifier of destruction. Here is how the cascade begins. Too many participants lean the same direction, usually long in a strong rally. Silver had momentum, silver had narrative, silver had enthusiasm, open interest builds, positions crowd, confidence grows, then something shifts. Maybe the dollar spikes, maybe yields rise, maybe margin requirements increase, maybe a large institutional fund reduces risk, maybe an algorithm detects a break in momentum. The first wave of selling hits. Normally, markets absorb selling gradually. Buyers step in at lower prices. But when leverage is high and liquidity is thinner than it appears, absorption fails. Stop losses trigger. Risk systems automatically cut exposure. Volatility rises. And once volatility rises, exchanges respond. They increase margin requirements. Now traders must post more collateral immediately to maintain positions. If they cannot, their positions are liquidated automatically. No negotiation, no debate, no second chance. That is where the speed comes from. When forced liquidation begins, price doesn't move in increments. It gaps. And when price gaps, more stops trigger. This is how you get 30% in hours. Not because silver became worthless, because leverage became unbearable. Now here is the deeper layer most people miss. In modern markets, liquidity is conditional. It exists when volatility is low. It vanishes when volatility spikes. High-frequency trading firms provide much of the visible liquidity in futures markets, but they do not absorb directional risk during stress. When markets turn violent, they step back. That leaves the order book thin. And when the order book thins, even moderate selling looks massive. Now add algorithmic momentum systems to the equation. Many trading models are designed to sell into weakness and buy into strength. They do not evaluate fundamentals. They evaluate price behavior. Once the decline began, these systems accelerated it. The move became mechanical. Now let's zoom out. Was this the most violent sell-off of our lifetime? In terms of speed and magnitude combined, it ranks near the top. Silver has crashed before. 1980, 2011, 2020. But what makes this event unique is structural fragility. In 1980, leverage was high, but markets were less interconnected. In 2011, silver collapsed after a parabolic rally and margin hikes. In 2020, silver crashed during a global liquidity panic. This time, the environment is different. Global liquidity is already tight. Interest rates are elevated. Cross-asset volatility is rising. The financial system is more interconnected and more leveraged than ever. That means shocks propagate faster. Silver did not collapse in isolation. It collapsed in a world where capital is cautious, funding costs are high, and risk appetite is fragile. Now let's talk about the 30% number. When retail investors hear 30%, they think value destruction. But institutions think something else. They think positioning reset. When a leveraged market unwinds violently, weak hands are removed. Speculators who were overextended are forced out. Open interest contracts, funding stress releases. That creates two possible outcomes. Either the market stabilizes at a lower base, rebuilding slowly, or the liquidation overshoots intrinsic value, setting up a reflex rally. But what determines which path unfolds? Liquidity. If liquidity conditions improve, stabilization follows. If liquidity tightens further, instability persists. Now here is something that should concern you. Silver often trades with a high ratio of paper claims to available physical supply. This does not automatically mean fraud. It means the system is designed for rolling contracts, not mass delivery. But in moments of violent paper liquidation, something psychological shifts. Investors begin questioning counterparty risk. They begin asking whether exposure equals ownership. And when that question becomes widespread, behavior changes. If enough participants decide they prefer physical metal over paper exposure, tension builds. Paper price may fall during liquidation, but physical premiums can rise simultaneously. When that divergence happens, you are witnessing structural strain. Now let's address a dangerous misconception. Many people assume violent crashes signal permanent weakness. History shows something different. After major silver liquidations, the metal has often experienced periods of extreme volatility in both directions. Crashes clear leverage. Cleared leverage reduces systemic fragility. Reduced fragility allows stronger moves later. But the timing is unpredictable. This is why emotional trading is fatal in silver. Silver is not a calm asset. It is one of the most explosive assets in global markets. When it rallies, it shocks. When it crashes, it shocks harder. Now let's examine the macro backdrop. Silver does not exist in a vacuum. It responds to real yields, dollar strength, inflation expectations, and global liquidity. If real yields rise sharply, silver struggles. If the dollar surges, silver feels pressure. If liquidity drains globally, leveraged commodities are vulnerable. So ask yourself, did something structural shift in macro conditions, or was this primarily a positioning event? If it was positioning, then the damage is technical. If it was macro-structural, then the damage is fundamental. Right now, the evidence suggests this was a positioning cascade amplified by thin liquidity. That matters, because positioning resets faster than macro trends. Now let's talk about you. There are three types of participants in a crash like this. The leveraged trader who gets wiped out, the emotional investor who panic sells, the disciplined observer who studies structure before acting. Only one of those survives long term. If you were leveraged, you learned a brutal lesson about margin dynamics. If you panic sold, you learned how fear overrides analysis. If you stayed calm, you preserved optionality. And optionality is power in volatile markets. Now let's address the most important question. What happens next? There are three realistic scenarios. Scenario 1, stabilization, volatility compresses, open interest declines, silver builds a base and trades sideways before a gradual recovery. Scenario 2, secondary liquidation. A bounce draws in weak buyers, then another wave of selling hits if macro conditions deteriorate. Scenario 3, divergence. Paper markets stabilize, but physical demand accelerates, creating upward pressure beneath the surface. Which scenario unfolds depends on liquidity and funding conditions. Watch margin policy, watch open interest contraction, watch delivery data and physical premiums, watch real yields, watch the dollar. Those are your structural indicators. Now here is the uncomfortable truth. Markets do not eliminate leverage permanently. They reduce it temporarily. Once volatility settles, participants rebuild exposure. If macro conditions later align bullishly, that rebuilt leverage can fuel a powerful rally. This is why silver's most violent crashes often precede its most violent rallies. The same leverage that destroys price on the way down accelerates it on the way up. So the question is not whether silver is dead. The question is whether this liquidation completed the reset. If it did, volatility will compress. If it didn't, instability remains. But one thing is certain, a 30% collapse in hours reveals fragility. It reveals how dependent the market was on borrowed conviction. It reveals how thin liquidity becomes under stress, and it reminds you that silver is not a safe, slow asset. It is a weapon. It magnifies emotion. It magnifies leverage. It magnifies mistakes, and it rewards discipline. If you understand structure, crashes become data. If you trade emotion, crashes become trauma. Silver was wiped out 30% in hours. That is not random. That is leverage meeting reality. Now the board is reset. The weak hands are gone. The volatility is elevated. And the next move will not be small, because when a market proves it can move 30% in hours, it proves something else. It can move just as violently the other direction. Position accordingly.